Right, welcome to part 2 of lecture 3, FMGT3224. We are just about to allocate overhead to job number A-143. We use direct labor hours and direct labor hours as the overhead allocation base, and we use a predetermined overhead rate, which has been previously calculated as $4 per direct labor hour. So we've got 8 direct labor hours incurred at this point. So 8 hours at the rate here, this will end up being $4, and we'll do the math, and that should work out to $32. And so assuming that this is all the materials and labor that went into job A-143, then we would have a complete cost right now, $236. And because we made 2 items in this particular job, the cost per unit is going to be 118. So 236 divided by 2 gives us the 118. So again, the allocation of overhead is based on this predetermined overhead rate. It is calculated using, and I will emphasize this again, estimated overhead divided by estimated allocation base. And it's important, obviously, that the allocation base be a reasonable driver of your overhead costs. How would we go about figuring that out, whether something was reasonable or not? Well, think back to the previous lecture when we looked at regression, right? If we can plot some history, if we have enough data points, we can run a regression, look at the R-squared, and we can look at overhead costs using a number of different potential bases and pick the one that's got the best R-squared, and that will give us a pretty good idea. We may want to just do some intuitive reasonableness checks around it as well, but that would be probably the best simple way to come up with the appropriate manufacturing overhead allocation base using regression to test various different possible drivers. Okay. So here's the thing. The overhead rate, the predetermined overhead rate is, as we said, based on estimates, right? So that's estimated overhead divided by estimated allocation base, but it is applied or allocated based on actual activity, right? So I can't emphasize that enough. It's the actual amount of the allocation base. So going back here, it was the actual 8 hours that of direct labor that we used. And this doesn't have to be direct labor. Remember, we can use any allocation base, the ideal one, whichever one fits best for our manufacturing reality. It could be machine hours, it could be all kinds of different things, right? But whatever that actual amount was, that's what we use times the overhead rate. So again, it's the rate itself is based on estimates. It is allocated or applied based on actual activity of the overhead allocation base. Okay, so we did the math here, and so on. So again, why do we use this estimate, this predetermined rate? It's because we don't yet know, and we don't want to wait to find out the actual overhead. So we don't know this, right? We won't know it until we get the invoices, add them up, and do a bit more math to it. Meanwhile, we may have already sold some of our products. So we want to be able to calculate the cost so we can see how much they're costing us to make, compare that with how much we're getting for them on a selling price, and have a sense of, are we making money or not? Are we pricing this thing too high, too low? Is it costing us too much to make? Can we only sell it for $50 and it costs us $56 to make? In which case, maybe we shouldn't make it. Right? So that's the kind of information we're trying to get, and obviously you want to know that information yesterday, not in 3 weeks' time. Okay, I just kind of finished talking about this. Can't wait until the end of the period, and so on. Okay, again, we talked a little bit about the usefulness of the applicability of various cost drivers as different allocation bases, and how you would go about figuring this out. The bottom line, the criteria here, or the criterion that you need to look at is the allocation base needs to be a driver of the cost, right? You're using it as a proxy to because it's easy to measure the allocation base. It's hard to measure the overhead costs going to each job. So we're using the allocation base as the proxy. So they have to kind of move in the same way. They have to have the same kind of cost behavior. Okay, so looking at an example here, we've got Pear Company. They apply overhead based on direct labor hours. Total estimated overhead is $640,000. Estimated labor for the year is $1,400,000. Yeah, whatever. And estimated labor hours are 160,000, right? So the predetermined rate is going to be estimated cost divided by estimated units of the allocation base. This is a red herring. It could be, though, that it's allocated on the basis of direct labor dollars instead, in which case that would be the allocation base. But that's not how they do it. They do it based on direct labor hours in this example. And so those are the two numbers that we're going to use. And the math works out to $4 per direct labor hour. So based on that different job cost sheet, how much overhead is Pear going to apply to this particular job? Well, again, the actual amount of hours is 26. 26 times the 4 will give you $104 of overhead to be allocated. And then to get the unit cost, the individual unit cost, take the total cost of the job, divide by the number of units, and that gives you the cost per unit of $105. All right, let's practice the allocation of overhead in brief exercise 4-5. Okay, so we've got Luthan Company. They use a predetermined overhead rate of $13.40 per direct labor hour. So that is $13.40 per direct labor hour. Predetermined rate was based on 19,000 estimated labor hours and estimated total manufacturing overhead. Yeah, whatever. Company uses actual now 19,800 labor hours during the period and incurred total manufacturing overhead costs of $249,000. So the question is, how much manufacturing overhead would have been applied to units during the period? Well, we would use this predetermined overhead rate times the actual amount of direct labor hours of 19,800, and that would give us a manufacturing overhead allocated, of 265,320. So this is overhead allocated. And you know, in the problem they talk about the actual overhead costs, which they would only discover weeks later, turned out to be 249,000. So we're a little over $15,000 over allocated in this particular case. And we'll discover how to deal with that in the next demo problem. But I just want to re-emphasize that this is the actual direct labor hours there. All right, so now let's look quickly at the flows of the documents and the costs associated with a job cost system. So direct materials comes out of, sorry, not direct materials, materials. Comes out of raw materials inventory. It will either, if it is a direct material and can be economically traced, it'll either go to the job or it will go into basically a bucket, a manufacturing overhead control account that is just, it just sits there and accumulates the overhead that the actual cost of overhead as the as the month goes by. And labor, same sort of thing. If it's direct labor, it can be traced to the job. It goes straight to the job cost sheet. Otherwise, it also gets dumped in the same manufacturing overhead account as the indirect materials. And so any other, and we've already sort of talked about the labor piece on the previous slide, any other overhead, electricity, rent, all that sort of stuff will also end up in this manufacturing overhead account. And then that account, you will use the predetermined overhead rate to do the applied overhead, to apply the overhead to the various jobs. So it's not actually the case that this overhead is then is somehow magically taken out of the overhead account and applied to the jobs. You apply it based on an overhead rate, and then at the end of the year you compare the actual overhead costs with the overhead applied and kind of net them out and deal with any discrepancy or difference at that point in time. So here they're showing it all in one account. Not a big deal. The computer, the accounting system will take care of all that stuff anyway. But if you like T accounts, this will describe the flow of costs. So out of raw material into the work in process, the job cost sheet itself, which is essentially work in process inventory. And then the manufacturing overhead account, the actual costs going in on one side, and the overhead being allocated or applied coming out the other side, and again going to the job cost, the work in process piece itself. And as the slide here indicates, if the actual and allocated overhead are not the same, then you will need to do an adjustment at the end of the year, and we'll get to that in a second. So when the jobs are done, the job cost sheet is complete. You then take it out of the work in process inventory and move it to finished goods as cost of goods manufactured. And then once you sell it, it becomes cost of goods sold, and so on. All right, so that's essentially the flow from an accounting perspective. I don't want to get into the whole journal entry end of this, but from an accounting perspective, that's the flow of the costs as an item is produced. So you can look at a little bit more detail here if you want. What's debited, what's credited, and so on. I'm not going to emphasize debits and credits and journal entries in this course, but it wouldn't hurt for you to have an understanding of this particular slide as well. Okay, so looking back to parent company, what happens if the actual overhead and the allocated or applied overhead is not equal? Well, okay, so actual overhead 650,000. Applied overhead, they want us to calculate. All right, applied overhead 680,000 here based on the calculation. So now what? One is the actual amount 650, but we applied to the individual jobs a total amount of 680,000. What do you do? Well, we're in a situation where we have what's called over applied or over allocated overhead in the amount of $30,000. And so what do you think happens? Well, you can do it a number of different ways. The simplest way of getting rid of this excess cost, and it could be underapplied too, in which case it's not enough cost. The simplest way is to just do a journal entry and dump it all into cost of goods sold. So this is the simple way. But it's not the best way. It only is accurate if you sold everything that you've produced in the period. But in reality, the overhead is going to be split up between a number of different accounts. You're going to have some ending work in process inventory that is going to be, in this case, have some over allocated overhead in it. You're going to have some of your products are going to be sitting in finished goods, and only those products that have been sold will actually be in cost of goods sold. So the most accurate way to deal with this over or under allocated overhead would be to figure out how much should go to work in process, how much to finished goods, and how much to cost of goods sold based on where the production for the period happens to sit. It will always end up being in one of these three, I guess one or more of these three accounts, and 90% of the time it will be in all three, right? You'll have some products that aren't quite finished yet, some that are finished and not sold, and some that are sold. And that's how you would go about allocating, ideally, this method. But if the dollars aren't significant, or if it's too much of a pain to go in and figure all that out, then you can use this, this method, which is what Pear Company does, the simpler method of dumping it all into cost of goods sold. And we'll continue this in the next part of the lecture.